It happens every 2 weeks. Your phone buzzes. Direct deposit received. And for a split second, you feel rich, until you open the app and see the number. Because your offer letter said one thing, but your bank account says another. Somewhere between gross pay and net pay, roughly 30% of your money simply vanished. Where did it go? And here's the bigger question. Are Canadians actually the most heavily taxed people on earth? Like your uncle insists at every family dinner? Today, we're putting your paycheck under the microscope and comparing it against the Americans, the British, and the Australians. The answer is going to surprise you. Let's break it down. First, you need to understand that in Canada, you don't pay one income tax. You pay two. Call it the double bite. The federal government takes the first bite through the CRA, and then your province lines up right behind it for the second. Here's how the federal side works in 2026. Your first $16,452 is effectively tax-free. That's the basic personal amount. After that, the brackets start climbing. You pay 14% on income up to $58,523. Then 20.5% up to $117,045. Then 26%, then 29%, and finally 33% on everything above $258,482. But that's just bite number one. Your province stacks its own brackets on top. In Ontario, that adds anywhere from about 5% to over 13%. In British Columbia, from about 5% to over 20% at the top. Alberta is the gentlest, starting at 8%, which is exactly why so many high earners in the GTA and the Lower Mainland fantasize about Calgary. Now, income tax isn't the only thing shrinking your deposit. Look closer at your pay stub, and you'll find two more line items, CPP and EI. The Canada Pension Plan takes 5.95% of your earnings, up to a ceiling of $74,600. And if you earn more than that, a second CPP contribution takes another bite, up to $85,000. Employment insurance takes 1.63%, up to $68,900, maxing out at about $1,123 for the year. And this explains one of the strangest feelings in Canadian financial life, the January to June squeeze. If you're a higher earner, you hit those annual maximums partway through the year. So every winter and spring, your take-home pay feels tight. Then one glorious payday in the summer, CPP and EI stop coming off, and your deposit suddenly jumps. You didn't get a raise, you just finished paying. Now for the fun part. Let's fly south, because every Canadian has heard the pitch. Move to Texas or Florida, pay zero state income tax, keep more of your money. And on paper, it's true. A six-figure earner in Dallas often faces a lower marginal tax rate than the same earner in Toronto. But the American paycheck has a ghost line item that Canadians never see: health insurance. In the United States, average family health coverage now costs well over $20,000 a year in total premiums. Even with an employer picking up most of it, the worker's share of premiums, plus deductibles, plus out-of-pocket costs, can easily push a family past $12,000 a year. Money that comes out after taxes. That's not a tax on paper. But try skipping the payment and see how optional it feels. So here's the honest framing. Canada runs an all-in model. Your taxes are the premium. America runs an a la carte model, lower sticker price. But the extras are mandatory. The grass isn't greener. It's just billed differently. What about our Commonwealth cousins? This is where the OECD becomes our referee. Every year, it publishes something called the tax wedge, the gap between what your job costs, your employer, and what actually lands in your pocket. It's the fairest apples-to-apples comparison on the planet. And in the latest data, the average tax wedge across all OECD countries sits at 35.1%, while Canada, the United States, the United Kingdom, and Australia all come in below that average. Read that again. The average Canadian worker gives up less of their labor cost than the average worker in the developed world. Meanwhile, Belgium tops the charts at over 52%, with Germany close to 50%. But the story shifts at higher incomes. In the United Kingdom, the punishing rates arrive early. British earners hit an effective 60% zone starting at just £100,000 as their personal allowance gets clawed away. Australia's top rate of 47%, including the Medicare levy, kicks in around 190,000 Australian dollars. Canada gives you more runway before the top brackets bite, which makes us the middle ground, heavier than America, often lighter than Britain in that brutal clawback zone, and competitive with Australia. Now, here's where most people get the math completely wrong. You've heard someone say it, I pay 50% tax. No, they don't. They're confusing their marginal rate with their effective rate. Your marginal rate is what you pay on your next dollar, the top bracket you've climbed into. Your effective rate is what you actually pay, averaged across all your income, and it's always lower. Why? Because Canada's system is a staircase, not an elevator. Your first $16,452, taxed at zero. Your next chunk, taxed at the lowest combined rate. Only the top slice of your income touches the top rate. Run the real numbers on someone earning $100,000 in Ontario, and their effective rate, everything included, lands somewhere in the mid-20s, not 50. So the next time someone at a barbecue claims the government takes half their paycheck, you can smile, because now you know they're quoting the price of their last dollar, not their whole year. But, and this is important, the 50% crowd isn't entirely wrong. They're just early. Because Canada does have a success tax, and it lives at the very top of the staircase. Once your income crosses roughly $258,000, the federal rate hits 33%. And stacked with provincial tax, the combined marginal rate in Ontario reaches about 53.5%. Quebec is nearly identical. British Columbia, the same story. At that altitude, for every additional dollar you earn, the government keeps more than you do. 53 cents to them, 47 cents to you. That's the moment high earners stop asking, how do I earn more? And start asking, how do I keep more? Which brings us to the part wealthy Canadians already know. The tax code isn't just a bill, it's a menu. And 3 items on that menu do most of the heavy lifting. Number 1, the RRSP. Every dollar you contribute comes straight off your taxable income today. In 2026, you can contribute 18% of your earned income up to $33,810. For someone in the top bracket, maxing that out can slice more than $17,000 off their tax bill in a single year. Number 2, the TFSA. No deduction going in, but every dollar of growth and every dollar you withdraw is completely tax-free forever. The 2026 limit is $7,000, and if you've been eligible since 2009, your total lifetime room now sits at $109,000. Number 3, the principal residence exemption, arguably the biggest tax shelter in Canadian life. When you sell your home, the entire gain is tax-free. A family that bought in the GTA 15 years ago could walk away with $500,000 in profit and owe the CRA absolutely nothing. So let's land this plane. Is the Canadian tax bill painful? Yes. Every 2 weeks, the gap between gross and net stings. But is it the worst deal in the developed world? Not even close. We sit below the OECD average. We pay more than the Americans on paper, but we never open a hospital bill. We get squeezed less brutally than the British in their clawback zone. Call it the Canadian discount. You prepay for healthcare, pensions, and a safety net through that line item on your paycheck. Whether that's a bargain or a burden depends on what you'd rather do, pay the tax or pay the premiums. If you learned something, make sure to like and hit subscribe. See you in the next one.